Welcome back to part 2 of this special edition Travillian Next podcast covering the rise and fall of Silvergate Bank. If you thought part 1 was good, tune in for more with Ben Reynolds as we talk about what the future of the banking industry could look like regarding stablecoins, tokenized deposits, and much more. And as always, make sure you subscribe for more industry-relevant content.
If it's okay, Mike, maybe we can define what a stablecoin is just for people really quickly.
Let's do that.
So essentially what a stablecoin is, at least in its current state, is it's a fully reserved asset. So the way it works is you pick a blockchain, let's say Ethereum, and then within Ethereum you create this thing called a smart contract. And the smart contract is where you mint tokens or you burn tokens. And so the role of the stablecoin issuer is to say, okay, I have $1 in a bank account, or I have $1 in a treasury. I'm going to now mint $1 in this smart contract that's now available on Ethereum. What that means is because Ethereum is decentralized, anyone that has a wallet can essentially hold this stablecoin that's, USDC or pick your favorite stablecoin. And then there's a dollar that's backing it in a bank account somewhere. So then you say, okay, well, how do we know that it's backed? How do we know that it's reserved? Most of the reputable ones out there, they're regulated. And if you're regulated, you get a monthly audit, right? And that monthly audit says, you know what, there are 1 million tokens that were minted from the smart contract. There's also $1 million worth of treasuries sitting in this custodial account, and those things match. So really all of the stablecoin is sort of a digital representation of an asset that exists in a traditional market structure format.
It's actually a really helpful explanation, but I also think it probably highlights two of the friction points to why stablecoins haven't been able to kind of become more meaningful yet, which is, number one, scale.
Yeah.
I mean, if you have to hold $1 for everything in circulation, that's not really scalable, right? It's not how like US dollars work. There's going to have to be a fractional reserve system at some point, which I think ultimately is where banks come in. You can correct me if I'm wrong, but we'll get there. But I think that's number one. But number two is there a kind of an inevitable endpoint where a bank that's issuing the stablecoin just is not able to know what wallets are connecting into Ethereum and utilizing that dollar for certain transactions. So maybe let's start with number one.
Yeah.
Because I think this is what people are paying for here, which is how can banks get more involved? You're head of stablecoins at BitGo, so maybe you could work in a little bit about what BitGo does in this arena and where banks fit in. But am I right in assuming that banks are, as a regulated balance sheet entity, the likely answer to that scale problem, or do you think I'm misrepresenting?
Yeah, no, I think you're absolutely right there, Mike. And if you zoom all the way out, right, and the first question you ask is like, how big is stablecoins going to get? Right, today it's about $200 billion in market cap. If this is the payment rail of the future, right, if this is potentially something that disrupts the card networks, do stablecoins become $2 trillion in value? Are they $20 trillion in value? Right? What is that number? Some people think, you can pick your best guess of what number those is, but most people think it's larger than 200 billion, which is today. And so then the question becomes, to your point on scale, is at what point do those fully reserved assets, if you will, start pulling funds out of deposits, right? And as we know, banks need deposits in order to make loans, and the economy needs loans and credit in order to grow. So, and the Fed is very aware of this, right? The regulators are very aware of this. And so I actually think that they're going to encourage a world where banks can take their deposits, tokenize them, and issue them out on the blockchain, right? And to your point on scale, I don't think the fractional reserve banking system is going away. I think actually our economy needs it. And so you need to have all of the mechanisms from banking in order to fulfill these stablecoin redemptions, if you think about it. So like one of the big risks in stablecoins is that all your stablecoin hold is that there's a run, right? Similar to a deposit run, right? And as soon as a holder of the stablecoin thinks, you know what, this dollar token that I'm holding might not actually be worth $1, then you have people running to the exits to say, give me my fiat dollars back, right? Here are the tokens. And if you think about what you need in order to fulfill that, it's all of the things that the banking system has, right? It's access to the Federal Reserve, right? It's access to the window to take these loans, right? To essentially have like liquidity. And obviously you need to balance that that balance sheet risk, the right way. So I really do think that if to sort of summarize this point, if stablecoins are going to be a meaningful payment rail, they will only be a meaningful payment rail if there is a way for banks to participate, because it just doesn't scale otherwise, right?
And when you say participate, you really mean kind of issue, because then they are kind of quote unquote responsible for that digital token, and its worth behind it through their access to the Fed and their balance sheet, and I mean, oversimplification, but
So let's break that down a little bit. So we just talked about Silvergate being the issuer for Facebook, right, through the DM and Libra arrangement, and then I also mentioned Silvergate launching its own stablecoin. I think that's still sort of to be determined. There's another way that banks can participate in stablecoins, and this is what Silvergate had a front row seat for. So some of our clients were firms like Circle and Paxos, who are stablecoin issuers. Mm-hmm. And what they needed, if you're a stablecoin issuer, so if you're a non-bank that's a stablecoin issuer, you still need access to the banking rails. So what Silvergate did was provide basic banking services, right? If you're a stablecoin issuer, you need two things. You need a transactional bank account and you need a reserve bank account. The transactional bank account is where your customers wire money in,
So I want to mint 100 stable coins. I have to wire $100 into a Paxos or whoever's.
Exactly. Okay. Right. And Paxos was banking at Silvergate. Circle was banking at Silvergate. Right. So you would wire in the $100 into the Circle bank account at Silvergate. Circle would see that $100 came in from Mike. You would also provide your Ethereum address. They would go to the smart contract, say mint 100 USDC, send it to Mike. What they would then do behind the scenes, though, is because Circle, I think USDC is currently about 55 billion in assets under custody, something like that. So what they would do, though, because Silvergate didn't pay interest, was they would then wire the funds to a reserve bank that would pay interest, right? So if you're a banker and you're saying like, well, how could I get into this stablecoin thing without being an issuer? You could provide either transactional banking services, or you could provide reserve banking services. Reserve banking services would be something like holding, just to follow up that example, Circle wires the $100 from Silvergate to XYZ Reserve Bank, invest
Bank of New York Mellon or
BNY, someone like that, buys treasuries. They then custody those treasuries at BNY. And then if you come for a redemption, then it goes the other way, right? So you say, hey, here's the $100 in tokens. Please give me my $100 in fiat. They liquidate the reserve. The reserve goes to the transactional bank. The transactional bank goes back into the bank account that's provided.
So in that case, if a bank wanted to do more on the reserve side, it's probably best summarized as kind of a low margin scaled, kind of low risk business, right?
Yeah.
So probably not something where if you were like a $5 billion asset bank looking to get into the space, probably a lot less enticing.
Right.
But if you were a larger bank with a bigger balance sheet, maybe that could be an entree for you to do some other innovative things and get involved.
Exactly.
But you could also get more involved just on the transactional side.
That's right.
Can we maybe spend another second breaking that down or double clicking on that?
Yeah. So on the transactional side, right? I mean, you're like, what's great about being the transactional bank, probably the best part is the learning that goes with it, right? So you certainly need a certain amount of education before you go into this. But then as the transactional bank, you're seeing all of the funds coming in and you're seeing like, oh, wow, I didn't expect that these funds were coming from, the third largest hedge fund in New York, or from this pension fund in this state. Mm-hmm. I didn't realize that these funds were coming from these different things. And so you get a really interesting seat in the transactional bank in terms of what this flow looks like. But then, it's a fee opportunity, right? You're not paying interest, so there is a bit of a deposit opportunity because
small. Yeah.
It's small because because if you think about it, for those redemptions, like I explained, like kind of a 1-for-1 type of flow. In reality, it's sort of net, right? So like maybe you wanted 100 USDC, someone else wanted to redeem 100 USDC. So like that transaction would never go all the way to the reserve bank. And so the stablecoin issuer needs to keep some amount of float at the transactional bank. That float is deposits that you can hold and you don't have to pay interest on.
Right.
So that's pretty interesting.
Yeah, for sure. So then let's talk about BitGo a little bit.
Yeah.
So I guess first, just tell me a little bit about BitGo. And so as we mentioned earlier in the intros, you're head of their stablecoin project, but more broadly, I know it's a kind of institutional focus exchange and custody and other services. So tell us a little bit about it.
Yeah. So our CEO and co-founder Mike Belshie has been doing this for I think since 2011. I think he founded the company in 2013. Really a pioneer in something called the multi-sig technology for custody. Right. So initially, the first problem that he was solving was people had Bitcoin. They were afraid of their Bitcoin getting lost or getting stolen or whatnot. And so he created this custody platform to be able to hold digital assets safely, securely in a multi-sig format. So now fast forward, Mike, to today, I think we've been public about the fact that we have over $100 billion in digital assets under custody. So these are things like Bitcoin, Ethereum, Solana. So if you're an institutional holder and you're afraid of losing your keys or losing your password or any of those things, you can come to BitGo and we'll safely and securely hold your digital assets for you. We also do that in a regulated way. BitGo is a qualified custodian, and so we're regulated in the states of South Dakota and New York.
Okay.
We have two different trust companies, and so we do that in a way that if you are required to have a qualified custodian by the SEC, you can hold those assets. Fast forward to the business today, it's a lot more robust than that. So we have trading services that we provide to institutions. We have staking services that we provide where you can earn a return on your digital assets. We're in the process of launching a stablecoin, as you alluded to.
Yeah.
So there's a bunch of financial services that we're building on top of this great foundation that we have of $100 billion in assets under custody. To put that number in perspective, I think is where I was going. I think Coinbase, when they went public, had about $90 billion in assets under custody at the time.
And so let's talk about the stablecoin initiative, because it sounds like, just based on everything we talked about today, you guys might see yourselves as doing a few different things, right? It could be maybe as the pipes for someone who wants to issue a coin. It could be maybe your own coin that could compete with like a USDC or something like that. And maybe, I'm missing something, even another third or fourth variation of this. So what are you guys working on and how's it look?
Yeah. So we are in the process of issuing our own stablecoin. It's going to be called GoUSD. We're going through the regulatory approval process for that now. Obviously, it's going to be fully regulated, fully backed by U.S. dollars, audited twice a month. Those will all be public information. But I think all of those things, kind of everything that you would expect. Maybe one thing that's interesting for this group is, the reserve will be bankruptcy remote. So because we're doing it in a trust structure, even if something were to happen to BitGo, those assets will be protected and not available to creditors. But I think one question is sort of like, and you were maybe too kind to ask it this way, but like, why does the world need another stablecoin?
Yeah.
Why does the world need a stablecoin from BitGo? I think there's a couple of reasons. One is it's pretty early innings, and so we just think that the market's going to grow. And I don't know if there's going to be 1,000 stablecoins, but I don't think there's going to be 2. So I think in a world where stablecoin market cap goes from 200 billion to 2 trillion, you need more players that are in there just to diversify some of the risk and things as we've talked about. But beyond that, BitGo will be the first sort of prudentially, maybe not the first, but both Tether is not regulated at all, I don't believe. And Circle is using a money transmission license framework, patchwork. So they don't have a prudential regulator for their stablecoin. One of the things that's interesting is in the Senate, there's this bill called, people are referring to the Genius Bill, And it actually requires that stablecoin issuers have a prudential regulator for the stablecoin. GoUSD, which BitGo is launching, will be that prudentially regulated stablecoin. But back to the question of why, I think one fair criticism of stablecoins today is that they're just used for kind of crypto trading on ramps and off ramps to exchanges, and I think that that's fair.
I would agree.
What we're seeing is this incredible adoption in emerging markets. And really the problem that they're trying to solve there is, imagine that you're a bank in Latin America. It's really hard to get a US dollar bank account, right?
Yeah.
It's really hard to go to any of the bulge brackets, let alone any of the smaller banks, and say, hey, we're a bank in Argentina, Bolivia, one of these types of markets, and say our customers want access to US dollars, right? Because it's a better store of value than their local currency. And so through our stablecoin, what you'll be able to do is you'll be able to offer your customers a US dollar equivalent. And BitGo can provide the infrastructure, right? So you could be a bank that knows nothing. This could be true for a US bank too. You could know nothing about digital assets, custody, any of these types of things. And you can use BitGo's infrastructure along with GoUSD to offer these US dollars to the end user. So really the use case is store of value and payments. Payments between emerging markets and developed markets. And maybe the last thing I'll say on this,
and that's for GoUSD.
That's for Go
your roadmap for that.
That's for GoUSD. And one of the reasons that that's true is because, and I think one of the people that are critical of stablecoins bring up all the time is, the payment system works pretty good in the US. I've got my Visa card.
Yep.
I like the rewards that I get for it. I like the mileage that I get for it. If I need to send you $20, I can do that through Venmo, Cash App. Pick your poison on what those apps are. Like, why do I need another way to be able to make payment? And I think that's Zelle, right? And I think that that's all really fair, right? None of us most of us have never struggled to get a US dollar bank account. But that's not the case in emerging markets. So once you solve that use case, now you have a bunch of folks that are empowered with dollars in a digital wallet on their phone that they can spend on platforms around the globe. And so I think what's underappreciated is sort of the unlock that comes from having these payment methods, having people around the globe hold dollars in their digital wallets that they can then spend, right, or invest in order to further their economic standing.
Would you say that, as it stands today, a payment using a stablecoin is more digitally secure than a payment using a debit or credit card from like a terminal? If you're thinking about like fraud and all those types of things, that's probably a very difficult question to answer. But what's your view on it?
Yeah, I mean, you asked a question earlier that I didn't address. And I forget exactly the way you said it, but it was something to the effect of, the sort of the end user and kind of, we were talking about stablecoins being distributed and being on Ethereum. And if you're the issuer, right, if you're the bank,
like the wallets that plug in.
If you're the bank and you're the issuer, now you have potentially like deposit customers out there that are holding your dollars, right, that you're responsible for, that you have the backing for. And one of my mentors, Alan Lane, who was the CEO at Silvergate Bank, I loved his analogy for this. He would talk about it and he said, this risk exists today, and it's almost like cash, right? So someone comes to your bank, they're an account holder, they say, hey, I want to withdraw $10,000 in $100 bills. Like, well, that's kind of a little suspicious, but it happens, whatever. Maybe they're going on vacation, they want to take cash, or
maybe they're going to Costco.
Whatever, right? Maybe they're going to Costco. Lately, right?
Price eggs and paper towels might need to double.
Yeah, you have 3 kids, right? Yeah, me too. So you think about it and you're like, okay, well, once those paper dollar bills leave the bank, they exist out in the wild.
Yeah.
And, the customer could be using them at Costco. They could be using them to go buy, guns or drugs or who knows what they're using those dollar bills to do. That risk exists today. Similarly, if they go out with 10 grand, they come back with 15, you have a series of procedures you're going to go through as a bank teller to say, oh, okay, this person came back with, $15,100 bills. You're going to file the appropriate forms or whatnot. I don't think this is any different.
Yeah.
You come to the bank, you get your $10,000 worth of stable coins. You go out and you do whatever you do with them out in the real economy. You could buy a truck. Maybe not a used truck.
Yeah.
You could do whatever with them. Right? You could invest golf cart. You could invest them in DeFi or whatnot.
Right.
But as soon as you want to bring those stable coins back to the bank and you say, okay, I want to convert these stable coins into fiat dollars, then the bank knows what to do. It's like, okay, first of all, is this a customer of ours? Do we know who this person is? Second of all, what does this transaction history look like? And you might ask some more questions like, hey, you started with 10, now you have 15. Like, what are you doing to earn these?
Yeah.
Right? So I don't think that that's any different than what we're doing today. Excuse me. And I think what's important about that is that's the way the real economy works today. So Tether is in terms of this use case we've been talking about, is by far the most adopted stablecoin that's out there. And people use it in the real economy in places where there's, where the dollar, whatever their local currency is deflating. They use it as a store of value, and then they want to pay for things with it. And so I think that's where the unlock kind of exists.
Right. And obviously Tether, it's just Mike Perito's opinion, but it's not the most reputable, highly regulated partner. And so my guess would be that room for more regulated, more transparent partners would be, especially because Tether's used much more globally than domestically.
Yeah.
And it almost feels like this might be an extreme oversimplification, but it's like USDC in the US, Tether globally.
That's right.
And so, trying to break down some of those barriers could be advantageous to whoever can crack that code.
Yeah.
Yeah.
Yeah, absolutely. And distribution, I think what's exciting for banks is distribution matters, right?
Yeah.
So, if you, in a world where you have 1 million retail users, the idea that they would have a tokenized deposit in their wallet where the deposit is sitting at your bank, but they have value on a blockchain that they can now spend when they vacation around the world or spend other places. I think there's going to be some interesting unit economics for banks that get into this earlier.
Yeah. And we've talked about this historically, me and you as well. I do think there's some perception things that I think the stablecoin and crypto industry could do a better job of trying to push out. Like you don't see Schwab offering penny stocks. There's some stuff that the further we can kind of divide, the more usable stuff for like a real bank, like someone listening to this can dive in, and the noise kind of takes a step back. Right now, it still feels a little joint at the hip.
I think one of the things that's interesting in this area, right, is I'm sure your audience saw the comments from Brian Moynihan from the Bank of America a couple weeks ago, right, where he said, hey, we're going to issue a stable coin, or he later then kind of described it as a tokenized deposit, but we're not going to do that until regulation comes, legislation comes. There's actually a bill that the Genius Act in the Senate, and I think it's the Stable Act in the House. I might have that wrong, but there's legislation there, and if that gets passed, the question then becomes how fast does adoption happen, and I think do you potentially get left behind? So I don't want to create any sort of fear of getting left behind here, but I think I was pretty young, but I remember when ATMs didn't exist, right? And ATMs were the big innovation in banking, right? And at first it was kind of novel, and people were like, oh, what are the risks? Do I have to do this and whatnot? And then eventually it became just the normal, right? If you're running a bank, you have to have an ATM machine. And I think that's one of the challenges in this industry is it's so regulated. How do you be innovative, right? And not, or do you end up being a fast follower? But once a Bank of America announces hey, this legislation passed, this regulation is here, we're issuing a tokenized deposit. Like, is it too late if you're a community bank or a regional bank?
Yeah. Well, I mean, my opinion is simply, and I'm sure you would share it, is being a novel bank or having a novel bank strategy is not easy.
Yeah.
But that doesn't mean it's not worthwhile or important.
Yeah.
You know? And I think there's a lot of really cool things going on in the industry with a lot of really small or big banks. And if no one was willing to try and think outside of the box, then none of it would happen. And so does that mean every bank needs to call you tomorrow and talk about, you know, being a transaction bank for GoUSD? Not necessarily, but we've published, I've published a thought that on Travillian Next that every bank should be using between now and midterms to really explore and ask these difficult questions. I think this conversation should be extraordinarily helpful for them and figure out where their bank can be effective and where they have the resources to maybe look at something that's a little different and out of the box. And ultimately, I can see a world, I don't think it's that crazy, where you have a lot of commercial banking customers using some type of digital dollar representation to pay vendors, to transfer to other employees or other stakeholders. I don't think it's that wild with how we operate today that's an outcome that's possible.
Yeah, no, and I think that's exactly right. And I appreciate the work that you guys do at Travillian. I mean, I think it starts with education, right? For those that might not have understood some of this conversation, when I started in 2016 in Silvergate, like I didn't know what Bitcoin was. And it's an educational process, and it's a process of getting your board up to speed, getting your management team up to speed so that you understand these things. And, start simple, right? Try to provide a transactional bank account to one of the blue chip names in the space.
Yeah.
BitGo is certainly one of them. There's probably 25, 50 real blue chip digital asset firms that have been around for 10 years, going on 10 years. Open a bank account for them, and try to spend time with them and try to educate yourself on what this technology is. It's really tough because there's a lot of FUD out there, and there's a lot of it's hard to really source the signal through the noise.
Yeah.
But if you can find that trusted advisor or someone that has been doing this for a little while to kind of help you navigate, like, oh, this is just junk, but this is real. So anything you can do on that, on that educational process. It's been fun to see your growth.
Yeah.
Because when you started covering Silvergate.
So this is a good point to kind of wind down here. Is what I would say is, and this I'm stealing your line is. No one's sitting here and saying there's not a lot of like pixie dust, stupid stuff out there in the crypto world, right? But there is a lot of real stuff too. And so that's your point. So find someone that can help you. And I've heard you in meetings make that kind of diversion, and I think it's important. But I remember when I first met Alan Lane, and he sent me an email, and it was these 2 links, these 2 videos about Bitcoin, and he said, "Watch these, and then go buy a Bitcoin, and you're ready." And that's what I did, and I was ready. But I always joke, and I really believe this. It's not every day that you can wake up in something as big as crypto is and only be like 5 to 7 years behind the leading experts in the space. Yeah. I mean, it really hasn't been around in a real institutional way for that long. Yeah. And so I think that if there's nothing else that you can take away from this conversation and other things, it's ask questions and learn and it's a lot of it still hasn't even been written yet.
Yeah. That's a great ending, but maybe if I could add one thing. One of the things I love about this space is just how approachable people are, in the digital asset space. Like, if you're a bank CEO and you reach out and you want to talk to a CEO of one of these 50 blue chip companies, chances are like you can talk to someone in this, if not the CEO, someone in the C-suite about the industry, what their needs are, whatnot. It's so, to your point, it's so approachable. Right? Jamie Dimon's not taking calls from anyone probably,
no,
right?
No.
But here, you can still connect with a lot of the C-suite that are in the space.
Yeah. So. I think last I heard Jamie Dimon was cursing at employees about return to the office stuff. Well, different podcast. But Ben, thank you so much. It was great. I really appreciate you joining us today. And as always, stay tuned to the Travillian Next channel for more great content like this. And thanks for joining us.
Yeah, my pleasure. Thanks for having me.